Hi there. I wanted to send you this quick, roughly 10-minute video on some of the more important tax law changes for businesses that are impacting you in 2018. And I am hoping that this will serve you a reminder of what we've already been discussing throughout the year. But I also want it to help you to make any decisions on necessary actions that you may need to take before 12/31 so that you can pay less taxes. Now, I can't begin to go into all of the changes that occurred in 10 minutes, but I can give you the bullet points that are impacting the majority of small businesses like yours. And this is merely a small piece of the topics that I'll be covering in my live webinars this month. I have scheduled 3 different days and times so that I can accommodate everyone's schedules and still get the information out to you. So please be sure to check the dates and times and sign up for one of them and then show up. It's really important to show up to them. This is my service to you, and I just want to help educate you and so that you can really make better decisions in your company, okay? And here we go. What I really think is most important for you to understand, and why I have this slide in here, is that this Tax Act was the biggest in the last 31 years. And it's over 500 pages of tax code, not math, not anything else. It is tax code, which is theory, okay? And it significantly changes the game for us, business and personal. So I want you to pay attention. This is a snapshot of the business side for you that I feel is important for you. My live webinars are going to talk about both sides, the business and the personal. So again, please come. So just as a reminder, I'm briefly talk about how do we cut taxes. So there's timing, there's income shifting, there's tax code, and there's products. This Tax Act was primarily about the tax code. That's what you need to know. But the tax on the business entities is really what I'm talking about right now. And so that includes C Corps, S Corps, LLCs. There should be partnerships and LLCs, and so briefly, we just talked about the 21% flat tax on C Corps. So the other thing that changed was that the personal service company tax was eliminated, and the corporate AMT tax was eliminated. So that's really nice. Some of the things we're going to talk about in the live webinar are why would you continue to have a C Corp, because there are some, the rules now make it more valuable to business owners and investors. So we'll talk about that because there is some shifting we can do and longer term planning around C Corps that you cannot do in other entity types. Additionally, this is on the qualified business income is in addition to your current types of income for business, which are your ordinary, your investment, your passive. Qualified business income, otherwise known as Section 199A, or you've probably heard of 20% deduction. It's a calculated number. It's the new income I've talked about. It does not apply for C Corps. It applies for all other business types. We're going to go into it a little bit more, and we'll certainly go into it in more depth in the live webinars. But for this particular slide, just understand, not for C Corps. QBI, which is the qualified business income. What is it? Well, it's, as I said before, a calculation. But in effect, it's going to be your net income from your business, with some minor alterations, and then with the limitations applied on top of it, which we'll talk about soon. But if you wanted a definition, this slide kind of helps. There are 3 really big limits, and this is part of where the complication is. The first one is a specified service business. The second is the There's a W-2 wage or depreciable asset limit, and then there's a 20% overall limitation. So we'll talk about those real. This limitation is probably the biggest one, and I expect it to be litigated a lot. It will go to the Supreme Court, I am sure, over the next few years, and every court in between. So it's important, and most of us will be hit by it. So it's really important to understand it. So there's a limitation for service businesses that fall in this realm, and we supposedly can't take all of it, all of the QBI against our income. There are phase-ins and phase-outs of this rule, and also rules on gross receipts where it applies. So we need to pay attention to this, and again, this is something I will go into in much more detail in our live webinar. Again, really important, and there are going to be a lot of businesses, and this is what I want you to pay attention to. There's going to be a lot of businesses where you have both the specified service business and you also sell a product, and you may not have been separating those items out before, so we could have some really significant accounting changes, you know, from a bookkeeping standpoint to deal with. So we'll probably need a follow-up conversation on that piece if you are worried about that. The other limit, the W-2 and or depreciable basis limit. So there's limits based on how much wages the company pays, and then also how much assets, some qualified fixed assets that you may have placed in the business. So we take the lesser of the calculation. It's just a secondary limit, okay? Then the last one is the 20% limit, and this one's more important in a certain respect because it applies to everybody. So we're going to take the new law, limit your overall QBI deduction to 20% of your taxable income. And you think that's easy, but it's not, because of course it deducts certain things out of that number. It also comes off of your taxable income, so it doesn't. So don't think that it's going to reduce your self-employment tax. And I want to remind everyone, your self-employment tax is Social Security and Medicare. It's actually not income tax. It just merely is reported on the income tax return. So that's why it doesn't do that. And it also doesn't reduce your income for determining if you're subject to the net investment income tax, nor is it allowed in determining a net operating loss deduction, which we'll talk about in a minute. One of the topics that most people are interested in, because it's a very tangible thing, is depreciation. If you're buying a fixed asset this year or next year, but it's good to just always remember depreciation on your fixed assets. Section 179 was expanded for a higher dollar amount. It's also been made permanent. That qualifies for new business equipment. The second piece is our bonus depreciation, which is 50%, similar to Section 179, except you take 50% of the cost rather than 100% in the first year. And the change on the 50% bonus depreciation, which is kind of cool, is that you can use it on used equipment. So it does not have to be new like it did in the past. So that is a really big change. We'll be going into that more in the live webinars, okay? All right, another one that is pretty controversial, although it's gotten better with some extra definitions. Meals and entertainment for business. Okay, if you have entertainment expenses like sports boxes, you're not going to be able to deduct them. Meals, you're going to continue to deduct them at 50% for the most part. refer to the table. We'll talk more about it in depth. This has actually changed since the rule first came out. So just be careful, and when in doubt, just make sure that you record really good notes on as you're supposed to anyways for meals, and then we will continue to deduct them at 50%. The Tax Act changed how we deal with net operating losses for businesses. So prior to 2018, meaning 2017, if you had a net operating loss, then we could choose to carry it back to the 3 prior years and apply it and hopefully get a refund or reduction in taxes. And then you would carry it forward after that. Well, in 2018, we can't do that now. We have to only carry it forward, and there is a limitation to 80% use per year. So if you had a net operating loss that could be applied across multiple years in the future, you couldn't take 100% of it in 1 year. You'd be limited to taking it 80% of that. So it's going to extend the time that you can take it, and obviously you can't take it back and get a refund now. Well, now that I've probably confused you a little bit, and I apologize for that, where do we go from here? Again, going back to my original statement, I want you to just know that there are changes that are really significant for you and your business. And I also want you to know that there's things we can do about it. It's not too late. And I'm always telling people that. So we can diagnose, prescribe, and fill a prescription for a problem like you would a medical doctor would. So the first thing is sign up for the live webinar and show up. That's really important. Get on my calendar to do a much more complete tax projection and some tax planning, so that we know where to do. And then we can talk about a longer term, bigger picture tax strategy type work, where we're going across multiple years and really digging into how your business can help you in not only the business side, but in your life. Thank you so much for listening, and I look forward to seeing you in the live webinars.